Hi, I'm Tim Kelley from the Montgomery Fund and welcome to this week's Video Insight. 2015 has been an interesting year in the markets. We saw some strong gains in the ASX 200 index early in the year that took it close to 6,000 points, and then some big declines that took it below 5,000. More recently, it's recovered a little to around 5,175 points today. When you see the market moving around a lot, it's natural to ask where it might go next and whether now is a good time to be invested. As many of you know, we don't think it's helpful to try to forecast short-term moves in the market, and it doesn't form part of our investment process. In the short term, we think that the market is much too random for that to be a useful exercise. In the long term, however, we do think it's useful to think about whether the market represents good value, because in the long run, it certainly makes sense to buy when markets are cheap and be a little more cautious when they're expensive. So where are we now? Well, our analysis is showing that the types of business we like to own are not especially cheap at the moment, despite the market having pulled back from its earlier highs. So we're still holding a reasonable amount of our funds in cash, and there's a good reason for that. This chart shows the performance of the ASX 200 index over the past 2 years in white, and the performance of the materials part of the index in green, and the healthcare part of the index in yellow. What we've seen over the past couple of years is commodity producing companies in the materials and energy sectors doing poorly, and that's helped to drag the overall market down. We generally take a dim view of the quality of commodity producing businesses, so from our point of view, the things that have been getting cheaper don't hold much interest for us. On the other hand, some parts of the market have been doing well, including the healthcare sector, where we feel that high quality businesses are more common. From our point of view then, good businesses haven't necessarily gotten much cheaper in the recent market declines, so we've had our hands in our pockets and continue to hold a significant part of our portfolios in cash. Holding cash is not much fun, especially when interest rates are at very low levels, and there's every chance that share prices for good businesses can continue to rise in the months and years ahead. However, at some point, it's likely that we'll see better value on offer than we see today, and we'll have a chance to deploy that extra cash. In the meantime, we're happy to wait. That's all for this week. We'll be back with more next week. And in the meantime, you can follow us on Facebook and Twitter.